What's up, millennials? In this video, we're going to take a look at the valuation of Microvast, which is a company that's going to be acquired by the SPAC that's currently trading under the ticker symbol THCB. Now, this valuation video is going to be a little bit different from the normal valuation videos that I do. It's going to be a little bit longer because I elaborate more on the terms that I use. Enjoy! So Microvast is also a battery company. Again, I haven't really done additional research. I just scrolled really quickly through this investor presentation. So let's see if we can find anything. CEO and founder Yang Wu. I usually like it when companies have a founder, which is, well, what do you call it? A founder CEO? Man, I forget the word, but whatever. You know what I mean. That the current CEO is actually also the founder of the company. Joined in 2006, so this company has already been around for 14 years or 15 years. That's quite something, actually. If that's actually true. Let's actually take a very quick look. Microvast. Can we see that? Yeah, 2006. Okay. That's interesting. Gewoon Nederland hoor. Mooi zo. Yeah, I thought you were saying u to me, which is usually something like Flemish people do, right? Found this channel by YouTube recommendations. Just subscribed. Let's go. Thank you, John Deere. John Deere. Beautiful tractors. I grew up on a farm, by the way. Beautiful tractors. Anyways, thank you, John Deere. Welcome. Okay, so Microvast, battery company. Let's see. So they're going to begin battery production in 2021, this year, in Berlin, Germany, actually. That's pretty funny. Did they already start producing in China? I think they already started producing in China as well. So it looks like they already have a business model, but I believe they don't really have a lot of revenue just yet. Well, they do have quite some revenue, but not like an insane amount, right? I think that's over here. Yeah. So I think this is the revenue number. Let's see, this is page 20. This is actually better. So here you can see the revenue of this company scaling up. And this is sometimes something that worries me a little bit. So they have been around for 14 years or 15 years. They, in 2020, had revenue of $101 million. In 2021, they expect that to go up to $230 million. And then in 2030, they expect to have $6.8 billion in revenue. That sometimes, I find that a little bit odd sometimes, because they have been around for 14 years or 15 years. And now all of a sudden they start saying that they are going to grow like 100% each year. Well, not each year, but for a few years they do expect to grow at almost 100%. I'm just not sure if they're going to achieve that. If they're going to achieve that, that is going to be awesome, because then this is going to be an awesome company to invest in right now, I would say. So yeah, always keep that in the back of your mind as well. To be a little bit like critical, if you will, a little bit skeptical of these future predictions, predurptions, as Crown's Crypto Cave calls them, predurptions. Yeah, be a little bit skeptical over there, okay? With regards to the EBITDA, they right now have a negative EBITDA of minus 12 million. And in 2020 or 2030, they expect that to go all the way up to 1.5 billion. And that is going to give them an EBITDA margin of 23%. So again, 23% basically means that the EBITDA is 23% of their entire revenue, okay? Very well, very well. So let's see if we can find some numbers, or let's see if we can find some transaction details. Oh yeah, I think this is in the beginning of this investor presentation actually. And they weren't very clear with regards to their transaction details. So let's actually see if we can find it. It should be over here. Yeah. So usually what SPACs have is a very nice breakdown on the amount of shares that are going to be outstanding, the percentages that are going to be provided to the SPAC and the founders, etc. Right here, it's a little bit difficult to find, but I did notice that they have it right over here in the very small letters in the footnote. Okay, so they at least say, okay, we have a pro forma equity value of 3 billion. Let's now find why that is 3 billion. And let's also go to our Excel sheet, which is over here. That is PDAC, and this is THCB. Let's see. Let's make this a little bit smaller. let's make this a little bit bigger. We're going to be having 300.5 million shares outstanding after the merger. And that includes all these shares that are right here, but well, for now that doesn't really matter too much. Okay, so the amount of outstanding shares is going to be 300.5 million, which is the number that I put over here in my Excel sheet. And again, keep in mind, because of warrants, because of earnout shares, that number of 300.5 million shares outstanding after the merger could be higher at the end, okay? Keep that in mind. For now, however, we're going to be working with this number over here. Very well. So if you take that share price of $10 per share and you multiply that by the amount of outstanding shares after the merger, 300.5 million shares, you're going to arrive effectively at that market cap of $3 billion, right? So pro forma, after the merger, this company, Microvast, based on a share price of $10 per share, is worth $3 billion, okay? Important, because some people, again, say, well, this SPAC is only, I don't know, maybe 300 million or 500 million. No, you need to look at all the outstanding shares after the merger. Very important. Very well. So that is the pro forma market cap based on a share price of $10 per share. Now, with regards to the amount of net cash they're going to have on their balance sheet. First of all, what they say is we have $3.0 billion in pro forma equity value and $2.4 billion in pro forma aggregate value. They have a little bit like different names, but I believe pro forma aggregate value is simply the enterprise value, okay, the firm value. If you go back to the footnotes, we can see in the number over here, number 5, I believe. Yeah, so in the footnote number 5, and I'm going to zoom in a little bit more so you can hopefully see this a little bit better. This footnote over here, they say that they have a debt balance of 171 million, okay? So that's a net amount of cash of minus $171 million. They also say they're going to have an amount of cash on their balance sheet of $772 million. So that's a plus. Okay, so that plus 772 is a positive amount of 601 million. They also say that they're going to have a net amount of $40 million in estimated transaction expenses. Quite expensive, by the way, but okay. So this is a negative number, minus 40. And then they also say that they have $30 million in debt repayment. So I'm not entirely sure, not 100% sure if you need to subtract 30 million or add 30 million, because I'm not sure if they want to say, okay, we have 171 million and we're going to subtract 30 million from that. So that would leave a net amount of debt of 141 million. Or they say, well, we have 171 million after we have paid $30 million in debt. You know what I'm saying? So I'm not 100% sure if this is something you need to add or if you need to subtract this. And yes, this will be uploaded afterwards, Aitor. So have fun at the party. Oh wait, you're late to the party? Okay, this is not a party. I've got only water here, not vodka. Anyways, so I'm not entirely sure if we need to add or subtract the amount of debt repayment. I'm kind of guessing that they mean to say that they have $171 million in debt and they're going to pay down $30 million of debt of that 171 million. You know what I'm saying? So basically the net amount of debt is probably going to be 141 million instead of 171 million. So in that case, you would need to add back 30 million. Right? Are you still following me? I hope you agree with this. If you don't agree with it, let me know. And then, let me know. Because also the thing is, we saw that the market cap or the equity value is 3 billion and the pro forma enterprise value basically is 2.4 billion. So again, if you take this amount of net cash of 591 million, you would effectively arrive at more or less $2.414 billion. So that kind of makes sense to me. But I'm not 100% sure about that. So yeah, again, I'm not 100% sure if this is the correct amount of net cash. Okay, but all of this is based on a price per share of $10 per share. Well, if you go into TradingView and you go to THCB, you can see that the current price per share is $18.38, which is also the number that I put in here in my Excel sheet. And that means a few things. That means that the current market cap, or sorry, the pro forma market cap, has gone up from 3 billion to 5.5 billion already. Okay, so the pro forma valuation, the pro forma market cap of this company, based on a price per share of $18.38, is already $5.5 billion. Okay, so Microvast is already worth $5.5 billion. Keep that in mind, it's important. Then, if you subtract the amount of net cash, which is going to be under balance sheet, you're going to arrive at this enterprise value of $4.9 billion. So again, market cap minus net cash is enterprise value. Very well. So currently, based on a price per share of $18.38, the company, Microvast, is worth a little bit more than $4.9 billion. That's already quite a bit. Especially for a company that isn't really producing a lot just yet. First time here, but loving the stream. Welcome, Pavan. Great content. Thank you. I appreciate that. Very well. So this is the pro forma enterprise value and the pro forma equity value, or pro forma market cap, if you will. If there are any questions, let me know. I'm going to take a little sip of my water. If there are no questions, we are going to go to the fair enterprise value. Fair enterprise value. Let's go back to this. Let's actually make it a little bit bigger. Let's go all the way down until we find the sheet that we need, which is going to be this one. So, Pavan tries to keep up taking notes. Love it. Actually, Pavan, if you look at the video that I uploaded on Friday, there's an entire SPAC guide of all the steps that I'm doing right now as well. And, well, that might be a little bit useful as well, okay? And I'm also going to upload this live stream later on, so then you can actually watch this back as well. Okay. So for Microvast, we're going to be looking at a fair enterprise value. We, instead of the EBITDA, which we used in method number 1, right now we're going to be looking at the revenue of Microvast in the future. Okay? For the fair enterprise value, we need two numbers. First of all, we need the amount of revenue in a certain year, and we need a certain revenue multiple. Well, the revenue for a certain year is very straightforward. And by the way, for this valuation, we're going to be looking at all the numbers of 2025. Why 2025? Well, that's the number they also use to compare themselves with other companies, which we're going to talk about in a second. So 2025. Well, not sure if it's close to this one over here. Yeah. So here we can see all their revenue, their predicted revenue, of course, and predicted, as always, is an important word. Their predicted revenue numbers over the next coming years. In 2025, they expect to have $2.348 billion in revenue. $2.348 billion in revenue. So that's the first number we are going to be using. And it's also the number that's over here. So that's a little bit easier. And we saw, well, the enterprise value currently, or not currently, based on a price per share of $10 per share was 2.4 billion. So the revenue to enterprise value ratio is almost 1, right? Enterprise value 2.4, revenue almost 2.4 as well, 1. Okay. Exactly what we see over here as well, a revenue multiple of 1x. The question now is, what is a fair multiple? Because 1 might be too low. Maybe it should be 2, maybe it should be 3, 4, 5, 6, 1 million, whatever. So what we're going to do is we're going to take a look at comparable companies in the space out there. And let's take a look at what kind of revenue multiples they are trading at. So if you take a look at QuantumScape, for example, we don't see any numbers for 2025. If you take a look at Romeo, for example, We do see a multiple of 1.2x, but of course Romeo is a little bit in the same boat as Microvast. They have a little bit of revenue, but they don't really have a lot of revenue just yet. Well, we can also take a look at companies that already are quite well established. Companies like Ballard, Plug Power, Tesla, NIO, CATL, Proterra, Nikola. And we can take a look at what kind of multiples they are trading at. Well, if you take a look at these multiples, you can see quite high multiples like Ballard and Plug Power and Tesla have quite high multiples. And my question to you is actually, what do you think is fair for Microvast? Is it fair to say that Microvast should be having a high multiple, just like Ballard, Plug Power, Tesla? Or is that too high? Should we maybe be looking at these lower multiples? Should we be maybe looking at Proterra and Nikola of like 1.9x, 1.8x? Or should we be looking more or less in the middle at NIO, at CATL, which is also a battery company, of 4x, 4.7x? Well, they say the median number of these companies is 4.7x. The median is simply the number in the middle. If you put them from low to high or high to low, as they did over here as well, from high Ballard 16x to low Nikola 1.8x, then the number in the middle is going to be 4.7x, which is the number of NIO. So they say, well, a median fair multiple or a median multiple for these companies 4.7x. Now, my question to you is, do you think that could be a fair multiple? Do you think we could maybe be looking at a multiple range of 4 to 5x? 4x on the low end, 5x on the high end. Actually, let me know. Maybe you can say, well, maybe that's a little bit too high. Maybe we should be looking at 3x to 4x. That changes a lot in the calculation. So if you have any opinions about that, let me know. And if not, then I'm just going to go on with 4x to 5x. No one protesting, so that's a good signal. Okay. So we now have our numbers. We've said in 2025, they're going to have $2.348 billion in revenue, which is the number that I put over here in my Excel sheet. We said, well, in 2025, if you look at these companies, they are trading at a median multiple of 4.7x. Well, we could say, okay, let's give ourselves a range of multiples. Let's give ourselves a low multiple of 4x and a high multiple of 5x. Very well. So if we pull up our calculator, we can now make our calculations. We can say, all right, $2.348 billion in revenue in 2025. Let's first multiply that by the low multiple of 4. That is going to give you an enterprise value of $9.392 billion with a B. Very well. It's also the number that I put over here in my Excel sheet. For the high valuation, if you go back to that revenue of $2.348 billion in 2025, and we now multiply it by the high multiple of 5x, you're going to arrive at an enterprise value of $11.74 billion. So that is also the number that I put over here in my Excel sheet. Then you can also say, well, what is the average between these two numbers? Well, the average of this number and this number is this number, $10.566 billion. So the midpoint fair enterprise valuation in 2025, or not in 2025, but based on revenue in 2025 and based on a fair multiple in 2025, a midpoint valuation would be $10.566 billion. The fact that we have been looking at 2025 numbers for the company itself and also for the similar companies, the comparisons, means that we don't need to discount it back to the current time, just like we did in method number 1. Because in method number 1, we were looking at multiples from 2021 for comparable companies and 2024 for lifecycle. Now, we're looking at 2025 multiples of Microvast and also 2025 multiples of the comparable companies. So again, that means that we don't need to discount it back to the present. So that saves a little bit of time, saves a little bit of stress and stuff like that. Okay, so we don't need to discount this back to the current time. So what we can now do, this is PDAC, this is the wrong one. So let's go to the correct one over here. We can now say, these enterprise values, we want to go to a fair price per share. How do we do that? Well, a little bit earlier we said the difference between the market cap and the enterprise value is the amount of net cash they're going to have on their balance sheet. Okay. Well, if you take these enterprise valuations and you add back the amount of net cash, which again, as we calculated, was $591 million in cash, you're going to arrive at these fair market caps for all these multiples. So for the low multiple, you would arrive at a fair multiple, or sorry, a fair market cap of $9.983 billion. For a high multiple, you would look at a fair market cap of $12.3 billion, and a fair market cap for the midpoint valuation would be $11.2 billion. Okay, then the very last step would be to take these market caps and divide them by the amount of outstanding shares after the merger. Aha. So if you do that, if you take these market caps, these three market caps, divide them by the amount of outstanding shares, which we said was going to be 300.5 million shares outstanding after the merger, you're going to arrive at these fair prices per share. So for the low end, $33.22, for the midpoint valuation, $37.13, and for the high valuation, $41.03. Now these are quite relatively high prices because currently the stock is trading at $18.38. But again, you could say that these multiples are too high, right? Maybe you say these multiples are too high and maybe we should be looking at a multiple range of 3x on the low end and 4x on the high end. Then the price would already change to $29 on average, a midpoint valuation of $29. Okay, you can maybe even make the case that this should be even lower, maybe 3x to 2x to 3x. Then the midpoint valuation is already $21.50. Okay, so there are many things that you need to take into account. You can also say, well, the multiple is not the problem. Multiple is fine. Multiple from 4 to 5x, no problem. But the revenue, I'm not sure if they're going to go to a revenue of $2.348 billion in 2025. Maybe you think this company is only going to go to $1.5 billion in revenue in 2025. So if you do that, then you're also going to see that the midpoint valuation is going to go to $24.43. Okay. You can also say, well, you know what? The revenue is fine. The range of multiples is fine as well. The thing is, I think they're going to have many warrants that are going to be exercised after a merger. I think there are going to be many earnout shares that are going to be added as well after the merger. I think that they are going to issue more shares based on the amount of outstanding shares, based on the amount of authorized shares they currently have. So maybe you say, well, instead of 300.5 million shares outstanding, I think they're going to raise that to 400 million shares outstanding after the merger. Okay, so that also brings down your midpoint price per share to $27.89. So there are many, many factors: amount of outstanding shares, the amount of cash they have, the revenue in a certain year, the multiples that you're going to give to this company. All these factors have a very high importance to calculate the midpoint price per share. There are many variables, and each variable, if it changes, is going to impact the price. If all of the variables change, let's say, they issue more shares, they don't have any net cash anymore, they can't really get to this revenue, they're only going to get to, I don't know if this is enough zeros, yes it is, they're only going to get to $1.5 billion in revenue, the multiple range is too high. Well, if that's the case, this stock is only worth $13.13. Right? So there are many, many variables that you need to take into account. And of course, again, there are very many unknown variables. So you just need to make assumptions for all of these valuations. And that's usually the problem with SPAC valuations. There are many variables and many of them could be wrong. Okay. So I hope that makes a little bit of sense. Let's actually go back to the numbers we've been taking a look at earlier on. So yeah, based on 300.5 million shares, based on this amount of net cash, based on this revenue, based on these multiples, your fair midpoint price per share would be $37.13. Okay.